Today, that same paycheck barely covers the essentials. You're not imagining it. I'm Marcus Caldwell, and I'm about to show you the invisible wealth transfer happening right now that's quietly destroying the middle class. Over the past 15 years, something broke. If you work for a living, your income grew roughly 30%. Sounds decent until you see the other side. Financial assets, stocks, and real estate owned primarily by the wealthiest 10% grew over 600%. Not a minor difference. A chasm swallowing the middle class whole. Think about this in real terms. Family down the street. Combined income went from $50,000 to $65,000 over 15 years. Someone with a diversified stock portfolio saw wealth multiply 7 times over. Same country, same economy, completely different realities. And the gap's not closing. It's accelerating. Here's where it gets personal and dangerous. That wealth gap isn't just unfair. It's actively making your life harder every single day. When the top 10% control 90% of all stocks and those values keep soaring, these households feel wealthy. They spend freely on renovations, vacations, new cars, premium products. That spending props up entire sectors: luxury goods, high-end services, real estate in desirable areas. But when markets stumble, when portfolios drop even 10 or 15%, same households slam the brakes. They stop spending, delay purchases, pull back completely. Here's what nobody wants to say out loud. Our entire economic system has become dependent on keeping wealthy households feeling confident enough to keep spending. Not because politicians care about rich people more than working families, because when the wealthy stop spending, companies stop hiring, tax revenues collapse, government services get cut, unemployment rises. Suddenly, everyone suffers, not just investors who lost money on paper. This is the trap we're living in. Economy doesn't run on worker productivity anymore. It runs on asset owner confidence. Your job security, your wage growth, your community's economic health, all of it now depends on keeping stock prices elevated and real estate values high. We've built a system where the financial tail wags the economic dog. When that tail stops wagging, everything stops. Before I show you exactly how this mechanism crushes working families, if this intelligence matters to you, hit that subscribe button and turn on notifications. This channel exists to deliver market analysis institutions don't want you accessing. Your subscription directly supports independent financial research. Now let me show you the money printing mechanism destroying your purchasing power. Why did the connection between real economic growth and financial asset prices completely break down? Answer is both simple and terrifying. Money printing on a scale unimaginable 2 decades ago. When central banks create trillions of dollars of new currency, the money doesn't flow evenly through the economy, doesn't show up in your paycheck or your neighbor's small business revenues. It flows primarily into financial markets. Banks and large investors get access to newly created money first. They use it to buy stocks, bonds, real estate. Those purchases drive prices higher. More money chasing same assets equals higher valuations. People who already own these assets get wealthier. Meanwhile, that same flood of money eventually trickles into broader economy, where it shows up as higher prices for goods and services. More money chasing same amount of groceries, housing, healthcare. That's inflation. You get price increases without getting asset appreciation. This is why everything feels wrong. Even when headline economic numbers look decent, GDP grows, unemployment stays low, stock markets hit records, yet families are struggling more than statistics suggest. Gains flow upward to asset owners while costs flow downward to everyone else. Not a conspiracy. Simply how monetary expansion works when wealth is already highly concentrated. Let's talk about what's happening right this moment. Forces pushing prices higher are intensifying, not subsiding. China became single largest contributor to global money supply growth over past 15 years, injected more currency than any nation, including United States. Pattern shifting dramatically. Chinese entities now aggressively buying physical commodities: gold, silver, copper, rare earths, agricultural products, energy, converting paper currency into tangible assets at unprecedented scale. When world's second largest economy hoards physical goods, it drives up global commodity prices. Higher commodity prices flow directly into everything you buy: copper in wiring, steel in appliances, rare earths in electronics, agricultural inputs in food. Silver prices surged, industrial metals climbing, agricultural commodities rising. Within months, commodity price increases reflected in finished goods. Your phone, car, food all cost more, not corporate greed or supply chains. Underlying raw materials genuinely cost more to acquire. China isn't acting alone, responding to same forces every major economy faces: massive debts unpayable at current values, aging populations, rising defense spending, crumbling infrastructure. Every government looking at same math: need more money than can collect in taxes. 2 ways to bridge gap: cut spending dramatically, political suicide and economic disaster, or create more money. Every government chooses option 2 every time throughout history without exception, playing out simultaneously across every major economy now. Japan perfectly illustrates where this ends. National budget 122 trillion yen, 6.3% increase, 24% from borrowed money. Total debt 230% of economic output. Not sustainable. Who buys these new bonds? Foreign investors losing confidence. Currency falling despite rate increases. Exports crushed by Chinese competition. That leaves one buyer, Bank of Japan itself. Purchasing 2.9 trillion yen monthly, $19 billion. Creating yen from thin air to buy own government bonds. Money printing purest form. Yen is world's third most important reserve currency. When Japan floods market with newly created yen, liquidity flows into global financial markets, increasing total money supply worldwide. That money pushes asset prices globally, eventually contributing to rising prices everywhere. United States faces identical pressures with more room to maneuver. Dollar remains world's primary reserve currency. American stock market 68 trillion total value, more than double entire economy size. Bubble inflated by years of money creation and artificially low rates. American stocks now overvalued 78% more than dot-com bubble peak. Exceeded valuation insanity that preceded most devastating crash in modern history. Still climbing. Too much money. Not enough places to put it. Federal Reserve cut 100 basis points late 2024, another 75 points last year. Expectations point toward 75 more this year minimum. Every rate cut makes borrowing cheaper, saving less attractive. 6 trillion sitting in money market funds earning 3.5%. When Fed cuts rates and yield drops to 2% while inflation runs 3% or higher, everyone loses purchasing power. Earning 2%, prices rising 3%. Guaranteed loss. They'll move money into stocks, real estate, anything outpacing inflation. Flood of money pushes asset prices higher, widening wealth gap. This is the mechanism crushing working families. Asset owners benefit from rising valuations driven by monetary expansion. Wage earners get hit with rising prices caused by that same monetary expansion. Same policy creates winners and losers. If you depend primarily on a paycheck, you're in the losing category. But here's what keeps policymakers up at night. They can't stop cutting rates and printing money without triggering the crash they've been trying to prevent. If interest rates stay high, stock market bubble pops. Wealthy households stop spending, companies stop hiring, tax revenues collapse. Government faces massive budget shortfall right when economy needs support. They'd be forced to borrow even more money at higher interest rates, making debt crisis worse. So they're trapped. Keep rates low and print more money, accepting higher inflation and wider inequality. Or raise rates and trigger recession that makes everyone poor. Neither option is good. Both have severe consequences. People making these decisions are simply choosing which disaster seems more manageable politically. Japan approved 118 billion emergency stimulus, largest since pandemic. Europe ramping defense spending, running larger deficits. China boosting stimulus to offset weak exports. Every major economy spending far beyond means simultaneously. Coordinated monetary expansion unprecedented outside wartime. When every central bank creating money aggressively simultaneously, no safe harbor currency. Everything devalued simultaneously. Only question is which currency loses value fastest. This is why commodity prices are rising globally. When people lose confidence in paper currencies, they move wealth into tangible assets, things that can't be created with a keystroke, things with intrinsic value and real-world utility: gold, silver, industrial metals, agricultural land, energy resources. Throughout history, when monetary systems become unstable, wealth flows back into physical goods. Watching that pattern play out again right now. Goldman Sachs predicts American inflation will gradually decline to 2.3% by December. Notice they're not predicting it reaches Federal Reserve's 2% target. They're predicting it stays elevated above target. And that's the optimistic scenario, assuming no additional shocks hit economy. If energy prices spike, if supply chains face new disruptions, if geopolitical tensions escalate further, inflation could easily run hotter than current predictions. Here's what this means for your household finances. Official inflation numbers consistently understate what people experience in daily life. Government's inflation calculation uses a basket of goods that doesn't reflect real-world spending for most families. Housing costs, healthcare expenses, education, insurance, these essentials dominating household budgets, have risen far faster than headline inflation suggests. If your experience is everything costs noticeably more while official numbers say inflation is moderate, you're not wrong. Your lived reality is more accurate than the statistics. Think about purchasing power this way. If your income rises 3%, but your actual costs rise 5%, you're getting poorer even though your paycheck is bigger. This is the hidden tax of inflation. Doesn't show up on tax return, but extracts wealth from your pocket every single day with every purchase you make. People who benefit from this system are those who own appreciating assets. Real estate that rises in value, stock portfolios that climb with market rallies, commodities that increase in price. People who get hurt are those depending primarily on wages that adjust slowly, if at all, while costs rise immediately. You can have strong employment numbers and rising GDP, while most people feel like they're falling behind. Because they are. Impossible choice facing working families now. Can't hold cash and wait. Cash depreciates when inflation runs hotter than interest rates. Money in savings earning 1% loses value to 3% inflation yearly. Guaranteed poorer by playing safe. But buying stocks or real estate at current valuations means buying historically overpriced assets. Might catch another year of bubble, or buy right before crash. No good answer. Both paths carry serious risks. Living through fundamental transformation of how monetary systems operate. Rules that worked for parents' generation no longer apply. Saving in bank, living within means, avoiding debt. Traditional virtues now lead to losing ground. System rewards leverage, speculation, risk-taking while punishing prudence and savings. Consider longer time periods. Inflation averaging 3% annually. Prices double every 24 years. Young person entering workforce sees prices double by middle age, double again before retirement. Unless income doubles same pace, falling behind. Wage growth doesn't keep up because labor has limited bargaining power where capital dominates. Quiet wealth transfer during sustained inflation. Value flows from wage earners to asset owners, savers to borrowers, prudent to leveraged. System rewards those who understand dynamics and position accordingly, punishes those following old rules. Your age, risk tolerance, time horizon, assets and debts all matter. Information helps you understand environment to make informed decisions. Decisions by central banks and governments now will have lasting consequences for everyone. Mechanisms driving trends accelerating, multiple reserve currencies weakening, asset valuations at extreme levels, governments requiring continued monetary expansion, consumer prices rising faster than statistics suggest, real wages stagnating, wealth concentration at Gilded Age levels. Whether gradual erosion over years or sudden crisis, direction is clear. Currencies losing value, financial assets disconnected from productivity, working families squeezed between stagnant incomes and rising costs. If this helped clarify what you're experiencing, share it with someone who needs understanding. Biggest risks hide behind official reassurances. What looks sustainable may prove catastrophic. What seems impossible may become inevitable. Massive monetary expansion has real consequences, showing in your grocery bill, rent, health care, Savings ability. Stay informed, stay skeptical, question narratives, trust your experience. Protecting financial security requires understanding forces most remain unaware of. Knowledge is first step defending what you've built in world where rules change and game is rigged against workers. Marcus Caldwell reminding you understanding the system is only way to navigate it. Stay sharp.